Welcome. So today we're going to measure and analyze portfolio performance. By the end, you should be able to compare our portfolio's performance with similar funds or similar investments to within our investment strategy. We should be able to use tools like Jensen's Alpha, the Trainer Index, and the Sharpe ratio to measure this performance. Think about an athlete, right? Comparing their performance across sports doesn't make much sense. Instead, we compare them within their sport. Similarly, comparing a tech stock fund to a bonds fund wouldn't provide much meaningful insights. So our task is to understand how to do that. Looking at our different goals for this chapter, again, we're going to talk about how asset allocation and market timing affect performance. We need to understand the value of active investment management. So imagine Netflix releasing hit shows during peak demand. Timing matters. Similarly, a portfolio's timing decisions can impact returns. We're also going to compare similar risk investments. We're going to look for returns exceeding required compensation for risk. Compare Apple Inc. stock to any other tech company like Microsoft, not a utility company, as their risk profiles differ. We need to make and understand the comparisons of companies, their similarities and their dissimilarities, so that we can make comparisons to choose better investments. In analyzing performance, we need to review things of similar characteristics. For instance, we always want to review based on risk. Assets of different risk level will naturally have different levels of return. Does that mean that one is better than the other? We need to assess what our required return is based on risk, and then make judgments on performance. We should then be able to make changes to our strategy to enhance potential returns. So can the return be higher than the required return? Well, certainly it could. However, we have to make proper security selection. We need to make sure that our asset allocation is properly set, and then maybe through some timing, we may be able to even get some higher returns. Step one, we need to determine after-tax costs. So what is the after-cost return of the portfolio? It's this return that we want to compare to others. Primarily, the factor here is taxes. Since some investment opportunities have different tax consequences, we want to look at after-tax cost. The next step is we need to find the category that best matches that portfolio. That way it will likely have equal risk returns. So we want to make category comparisons. If the portfolio is largely equity, consider some additional characteristics. So it's an equity fund, but maybe it's an international equity fund, or maybe it's a macro capitalization equity fund. So Morningstar places funds into categories like large growth or emerging markets. So Tesla belongs in a growth category due to its high innovation and reinvestment focus. So here's how Morningstar separates its equity mutual funds into similar categories. So if you were to look at the equity mutual funds that Morningstar relates to or publishes about, this is how you'd find them. So we could find what's referred to as a large growth fund. That type of fund only invests in large companies that have the characteristics of a growth company. Large value looks at large companies that for some reason seem to be currently undervalued. They might be really good choices right now for investing. Large blend funds look at big companies that are a combination of those two things. We can also look at sectors, right? Currently, a thing going on right now in sectors is the ETFs on AI. We can also look at international types of equity focus. So again, Morningstar provides categories for the sector, for the size, for the international flavor of different kinds of investments. For bond portfolios, we're going to categorize them slightly differently. They will be categorized by taxability, right? Municipal bonds or money markets. So we want to consider the maturity length and the risk. So U.S. Treasury bonds are categorized as government bonds. And of course, they are safer compared to corporate bonds in general, but then corporate junk bonds are a whole different category of risk. So when we look at the types of mutual funds with respect to debt, we see that there are different types of taxation, right? And here we see government bonds, a variety of other issues in here. High yield bonds, those are going to be junk bonds or bonds that have ratings higher than triple B. We'll talk about that later. Municipal bonds are issued by state and local governments. And money market securities are all invested in very short-term types of investments. So the Vanguard Total Bond Market Index Fund tracks the entire bond market and falls into the core bond category. So we're going to discuss the different types of investments in equity and bond markets in later videos. But for now, the picture here, or the moral of the story is, if you're interested in a particular type of stock or mutual fund, and you want to understand its performance, we need to understand what its peers do, right? We want to compare corporate bond funds. We want to compare those to other corporate bonds or corporate bonds to corporate bond funds. We wouldn't want to compare them to inflation-protected bonds. So these funds combine stock and bond funds. These are what we refer to as allocation funds, right? Sometimes they're based on a set allocation among asset classes. Sometimes it could be based on a retirement date. So allocation changes as that date becomes nearer. Some funds have alternative investments. Some funds focus on commodities, right? So again, these types of funds combine stocks and bonds. They adjust the allocation as appropriate. You can also combine other mutual funds. For instance, you could buy a middle risk mutual fund that puts 60% in a stock equity fund and 30% in an international equity fund and 10% in a bond fund. So the target date funds that are mentioned here shift from stocks to bonds closer to retirement. So the Freedom 2030 Fund is an example of this. And we'll talk about this in particular when we talk about retirement planning later on. So here are our return allocation funds. As you see here, they are strictly by allocation, right? So again, the best example here, allocation at 70 to 85% equity. That must mean 30 to 15% in bonds, right? Some of them are static, some of them are managed, some of them are geared towards retirement. So if you thought you were going to retire in 2050, you might want to invest in this target date 2050 fund. We also have ones that invest in alternative types of strategies. These are going to be a little riskier maybe because they invest in something outside of the equity and bond market. And sometimes we can even find allocation funds that invest in commodities. Once the after cost return of the portfolio is determined and the comparison funds are determined, then there are different ways we need to compare them. We can make comparisons by rank, right? How does that portfolio rank within the mutual funds in that category? And we also can look at comparison by return of the portfolio compared to the average return of other mutual funds in that category. So BlackRock's Capital Appreciation Fund ranks highly in its category for outperforming most peers. So let's see how we might do this. This is an excerpt from Morningstar on January 8th of 2025. One of the things we see here are returns. As we go across, here's the investment itself. There are annual returns each year for this particular mutual fund, and they're year to date. We can then see, well, what did the category do? Right? Here's the category's returns, and here's the index. So how did we compare to those? Right? So this is comparing returns. We can also look at the percentile rank. You can see year to date, this particular mutual fund is in the 10th percentile. So what does the 10th percentile mean? What does that mean? If you think about it, there's 100% of the mutual funds. In this case, there are 730 of them. This mutual fund is at the 10th percentile, which means there are 73 funds that perform worse than this, and there are 640 odd some mutual funds that perform better. So this particular year to date, we would say they're not performing quite as well as other mutual funds. If we look over here, 89%, this shows their quartile rank, right? Or the same basic idea. How are they performing compared to their category? So that's our start for trying to understand how we're going to measure performance. See you in the next video.